Cryptocurrency, often referred to as crypto, is a form of digital or virtual currency that uses cryptography for security. Unlike traditional currencies issued by governments, fiat money, cryptocurrencies operate on decentralized networks based on blockchain technology. A blockchain is a distributed ledger that records all transactions across a network of computers in a secure, transparent, and immutable way, ensuring that transactions cannot be altered or tampered with once they are confirmed. The most well-known cryptocurrency is Bitcoin, which was created in 2009 by an anonymous entity known as Satoshi Nakamoto. Since then, thousands of other cryptocurrencies have emerged, including Ethereum, Binance Coin, Litecoin, Solana Network, Ripple, known as XRP, Cardano, Polkadot, and some others famous. Each cryptocurrency operates on its own set of rules and can serve different purposes. Some are used as a store of value or a medium of exchange, while others enable smart contracts or decentralized applications. Cryptocurrencies offer several advantages, such as greater privacy, faster cross-border transactions, and lower transaction fees compared to traditional banking systems. However, they also pose risks, including high volatility, regulatory uncertainty, and potential use in illicit activities. Despite these challenges, cryptocurrencies have gained widespread interest among investors, tech enthusiasts, and businesses who see them as an innovative alternative to traditional financial systems. Cryptocurrency works through a combination of blockchain technology, decentralized networks, and cryptographic security. At its core, a cryptocurrency is a digital asset designed to function as a medium of exchange, just like money, but it operates independently of any central authority, such as a government or bank. Transactions made with cryptocurrencies are recorded on a blockchain, a public, distributed ledger that is maintained by a network of computers called nodes around the world. Every time someone sends or receives cryptocurrency, the transaction is verified by the network through a process called consensus, often using mechanisms like proof of work, mining, or proof of stake, staking, depending on the cryptocurrency. Once verified, the transaction is grouped with others into a block and added to the chain of previous blocks, forming the blockchain. This system ensures that all transactions are secure, transparent, and cannot be altered after they are confirmed. The cryptographic techniques used in this process protect user identities and maintain the integrity of the data. Overall, cryptocurrencies work by combining digital technology, economic incentives, and decentralized trust to enable peer-to-peer transactions without the need for intermediaries. Earning from cryptocurrency can be approached in several ways, each offering different levels of risk and reward, with two of the most prominent methods being spot trading and futures trading. In spot trading, investors buy and sell actual cryptocurrencies like Bitcoin or Ethereum at current market prices, aiming to profit from price fluctuations. For example, one might buy Bitcoin at a lower price and sell it at a higher price when the market rises, realizing a profit from the difference. This method is straightforward and suitable for beginners, as it involves owning the actual asset. In contrast, futures trading allows traders to speculate on the future price of a cryptocurrency without owning the underlying asset. Traders enter into contracts that obligate them to buy or sell at a predetermined price and date. This enables them to profit from both rising and falling markets by going long or short. However, futures trading involves leverage, borrowing funds to increase trade size, which magnifies both potential gains and losses, making it far riskier than spot trading. Beyond trading, individuals can also earn from crypto through staking, yield farming, liquidity mining, or even participating in airdrops and NFT sales. Some people offer freelance services and accept crypto as payment, while others lend their assets on decentralized finance, DeFi, to earn interest. Each method requires a solid understanding of the market, proper risk management, and the use of secure platforms or wallets to protect one's assets. The world of cryptocurrency trading is dominated by a diverse range of exchanges, each catering to different needs, from beginner-friendly interfaces to advanced institutional-grade features. These platforms facilitate the buying, selling, and swapping of various digital assets, driving the global crypto market. At the forefront are centralized exchanges, CXs, which act as intermediaries holding user funds and facilitating trades. Binance consistently ranks as the largest globally by trading volume, offering an immense selection of cryptocurrencies, derivatives, and a vast ecosystem of services, including NFTs and staking. Coinbase, especially popular in the US, is known for its user-friendly interface, robust security, and regulatory compliance, making it a go-to for beginners and institutional investors alike. Kraken stands out for its strong security, low fees, and extensive altcoin selection, catering to both new and experienced traders. Other major players include OKX and Bybit, which have gained significant traction for their comprehensive derivatives offerings, advanced trading tools, and global presence. KuCoin, often called the People's Exchange, is praised for its wide array of altcoins and innovative features like its Spotlight token launch platform. Crypto.com is recognized for its mobile-first approach, diverse crypto offerings, and extensive ecosystem, including a popular debit card. Crypto is incredibly volatile. Prices can swing wildly in a matter of hours or even minutes. What goes up quickly can come down even faster. Only invest what you are genuinely prepared to lose. Security is paramount. Always use strong, unique passwords. Enable two-factor authentication 2FA on all your accounts, and be wary of phishing scams. Never share your private keys or seed phrases with anyone. These are the keys to your crypto. Consider hardware wallets for storing significant amounts of cryptocurrency offline. Regulation is still evolving. The legal landscape for cryptocurrency varies significantly across the globe and can change rapidly. Stay informed about the regulations in your region and understand how they might impact your crypto activities. Do your own research, DYOR. Don't just blindly follow advice from social media or unverified sources. Thoroughly research any cryptocurrency, project, or exchange before you commit your funds. Understand the technology, the team behind it, and its potential use cases. Beware of scams. The crypto space, unfortunately, attracts many fraudulent schemes, including pump and dump groups, fake initial coin offerings, ICOs, and Ponzi schemes. If something sounds too good to be true, it probably is. Start small and learn. You don't need to invest a lot to begin. Start with a small amount, learn how the market works, and gradually increase your investment as you gain experience and confidence. And finally, remember that cryptocurrency is not a get-rich-quick scheme. It's a complex, innovative, and rapidly developing technology. Approach it with a long-term perspective, a willingness to learn, and a healthy dose of caution.